Hey everyone, Tony Mello Properties team. Hope you're doing well. 508-369-9755. 508-369-9755. Continuing with researching, learning, reading, understanding these flyers that one of our lenders had handed off to us in a recent meeting that we had with him. So I started reading this one this morning. There's numbers on the screen that you cannot see just because of the way it was, the color of the text that was on the flyer. When I scanned it, it didn't go through, so I kind of threw those numbers in there myself. Uh, so this one here, I think, and there's some questions. It compares the difference between you and uses $15,000 as an example. So let's assume that you have $15,000 above and beyond the other money that you're going to need that you could use to either one, price reduce, pay towards the principal and reduce the price of the loan by that $15,000. Buy down the rate, which would be, again, you give the bank the $15,000, and instead of paying, for example, 7%, you would pay 6%. That's just an example. You're buying down that rate. You're giving them, you're prepaying basically the interest that you would have paid on that interest rate. So it goes, instead of paying it monthly, you're paying it all in one lump sum up front, and it makes your life easier through the life of the loan. Or something called list and lock. So I was kind of reading the fine print in here, trying to, in my own mind, figure out what it is that's going on in here. They more or less use this as the basis, as the uh, base point that they're comparing these three options with. They're saying that between either paying it down and paying the principal, using the $15,000 to pay the principal down, or using the $15,000 to pay to have a lower interest rate, the difference between those two loans is this 280. So loan payment one would be 2,647. Monthly payment in this case, doing this specific thing, 2,367. Difference between those two numbers is that 280. Same thing here. 2,647 versus 2,271 is actually $376 per month that you'd be saving. So I kind of read through this, figured out the details, more or less the same kind of scenario. This is a rate of 7.25. This is 5.875. I assume the difference between those two rates is because you paid to have that rate down at that level. Using that rate, 20% down, 400,000. So there's a little bit difference in the loan amount. Gives you that difference. All right, so this list and lock, and I'm a little kind of not 100% on it because I don't know what the difference is. If you got $15,000 and you, as the buyer, pays down on that rate, or the seller gives a 3%, which equals 15,000. Why is this one? Why does this one give you a better rate, 5.5%? Versus the buyer putting in the same amount of money, getting a 5.875. So we'll leave. I was going to call Ray and I was going to ask him that question so that I could explain it properly here while I'm doing this video. But I figured, you know what? If I don't know and I don't ask and I don't explain and I send that to Ray and let Ray explain it in the Facebook page or wherever as I put this, the YouTube channel, it will create a way for people to have direct access to him as he's explaining my question. What is the difference between that and what is between that and that? Why is 15,000 in that scenario bring the rate down to 5.5, but 15,000 in that scenario only bring the rate down to 5.875? I'm sure there's a reason. I just don't see it right now as far as what the difference is, why does that happen that way. The benefit to me as a listing agent is that once I figure that out, I can explain this to sellers and try to convince them that if they do this, that they will get more for their property, or the property will come off the market faster. Um, to try to figure out what's the advantage of, and how do I market it and benefit, or share the benefits to whoever it is that I'm supposed to be targeting, and sharing those benefits with. All right, so this lock cannot be transferred to another property address, while list and lock can help buyers significantly. It is not a guarantee to lend. Obviously, this is just an example. These numbers may change, the rates may change. They probably hold the same program, so as things fluctuate and change, the idea is still the same. If a buyer is interested in purchasing the listed home at the advertised rate, they must still qualify for the loan, obviously. The benefit is that they won't have to qualify for the loan based on the higher market rates. Okay, more people will be qualified because the rate will be lower. Well, that makes sense. Where if the rate is high, you're paying more per month, and now you're priced out of the market of that particular property. Obviously, the lower the interest rates, the more people that qualify, just for exactly the same reason why there was a lot of people when the interest rates were 2%, 3%, 4%. More people came onto the market because they could afford more property. They will be qualified for less than lock rate. They will have several loan options to choose from. Your closing could extend beyond the 60-day period, and contact your loan officer to discuss extension possibilities. Sellers and buyers save the most with list and lock. Reach out today to get the most out of your money. All right. So I'm going to post this. I'm going to tag Ray the best I can, see if Ray can come in and say, and kind of just give us, two, three, four sentences explaining. And Ray, if you want to do at some point in time a webcast, video, blog kind of thing, we can certainly do stuff like that. So right now the question is, you've got the buy down rate, which is the middle option, and you've got the list and lock, which is the option towards the right. It's a seller credit. So it's the seller that is giving us, the buyer, the 3%, which equates in this case, this example, 15,000. Over there, the interest rate is lower. Over here, it's in the middle. And on the other side, which is what we typically tell people to do, the more you put down at closing, or the more you put down, the more you own, the less you have to borrow. You're not paying interest on that. But if these other options pan out and the numbers tell you that you're saving X amount versus these that option, or at least, it'd be foolish not to look at the numbers and figure out how it works, and whatever puts you in the best scenario, short term and long term. So, Ray, if you could kind of explain that just a little bit. What's the difference between the buyer paying down, that middle option, or the seller credit 3% and listing it and locking it at a certain price? And when does that $15,000 get paid? Probably at closing, I'm assuming. Let me know. Thanks. Tony Mello, Mello Properties Team, 508-369-9755. Hopefully Ray will have a chance to respond to that question. And when he does, then you guys can continue tagging on questions if you got questions, and you'll have an easy way to reach out to Ray to ask more questions. Or I know he's got other loan products because we're going through them right now. So give him a call if you've got any questions. Post it down below in the YouTube or Facebook page, and then we'll do the best we can to answer those questions. Have a good day. Thanks. See ya.